Hello again. My name's Miles Pitcher. I'm the owner of Superior Lending. I'm a loan officer located in Utah. I am an all-in-one expert and a huge fan of this loan product. I think it is absolutely fabulous in the right situations. We love it because it can help shorten the mortgage term of our clients, help them get their mortgages paid off way, way faster, and it can save them thousands and thousands in mortgage interest while at the same time preserving liquidity. I wanted to share with you today a scenario. I've adjusted some of the numbers, but I have a client right now who's purchasing a fourplex. And I wanted to show you what this would look like if we did a traditional mortgage versus an all-in-one on a purchase of an investment property fourplex. So we're going to look at this 1.1 purchase price. We're going to assume a 760 plus credit score. These are 2-bedroom units. We are guessing that rents are going to be about $1,750 per month per unit. On our traditional loan, they're going to require a 25% down payment. Rate as of today, July 5th, is 5.99, which is much of an improvement over where we've been the past month. The APR is listed right there. With an all-in-one loan, we do require reserves. We are assuming in our scenario the client has no problems on debt ratios, no problem on reserves. They're totally set on those. So we're going to plug both of these into our simulator. There's the address to get to our simulator. And I've taken some screenshots so that the numbers are big enough that you can see these. So first we enter our home value. Well, over here, we've compared it to a new loan because we're purchasing. So there's either going to be a new traditional loan or a new all-in-one. My client's purchasing with the all-in-one loan, and we have chosen investment property. The value, 1.1 million, we're assuming it will appraise for the purchase price. Loan balance, 825. We chose a 30-year fixed. The current rate on the traditional mortgage is 5.99, which is not bad. Principal and interest on that traditional mortgage is $49.40 per month. When we hop to the next page on our deposits, we're assuming our client, or just entering a number here, that they make $120,000 a year, or that's their net. They net $10,000 a month coming in. And then if you see these arrows down here, what I've done is added in by clicking on repeating deposits down here at the bottom. I have factored in the rents that they are going to receive from this fourplex. So 4 units receiving $1,750 per month is $7,000 per month. In the mortgage business, per underwriting guidelines, we don't always take, and very rarely do we take, the full $7,000. What we do is we assume there's going to be vacancies, repairs, maintenance that has to in these units, so we only count 75%. So that's what I've done here. 75% of the 7,000 is 5,250. You'll see that the average monthly deposits is 15,250. That's the 5,250 plus his base salary of $10,000 per month. Let's look at his spending now, what he has coming out. Now, what we do here is we look at where these arrows show. We look and see what percentage of his income is left over after household expenses, mortgages, cell phone bills, car insurance, all those things that happen. And I threw in a number of 25% left over, which would leave $3812.50 left over every single month. Now, if he has these deposits coming into his all-in-one and he spends out all of it except that $3,800 remains in there, he can draw it out in the future. But in the meantime, it reduces his mortgage balance, helping to accelerate the payoff and reduce the mortgage interest that he's paying. So let's look and see what the results or the simulator will show us with this scenario. So on the all-in-one, which is on the left, you can see that we would have this paid off in 10.8 years if we followed exactly what our numbers are. And you can see highlighted there with the arrow, it would save him $650,000 over the 30-year mortgage, assuming on the traditional mortgage, they're paying just the minimum monthly payment. Pretty crazy to see that and see what the savings are. I mean, that's a lot of years saved, and that's a lot of interest saved. Please note that this loan, the credit limit this borrower has of $825,000, that's going to remain there for them to continue to use in the future. We haven't put anything in assuming draws in the future, but that war chest or that amount of money there is available to him. As he pays it down, he can draw it back out again and use it for future investments, future acquisitions of additional rental properties. He can essentially become his own bank and just write out checks and buy properties in cash and then work to repay down the all-in-one loan again. It's a really cool and powerful strategy. Let's look at in the bottom left, there's a link called Rates and Assumptions. Let's go look at that. Actually, I meant pay down summary. So in the pay down summary, what I'm showing here is the break-even average rate. And this is very cool. I always like to see and think about, hey, what would happen or how bad would interest rates on the all-in-one have to rise up to for it to be worse than the traditional 30-year mortgage? And in this scenario, rates would have to go up over 12%, 12.1. You will also see on these pages the APR statements on there, but that is pretty cool that you can see that 12.1 break even. Now, back on this page, the rates and assumptions, we're running this as a 3-year fixed that goes adjustable. We are running it at a higher rate than where rates are currently right now. Rates are about 5.8 and as of July 5th, and we're running it about at a 6.2. So it's a little bit higher, a little more conservative. So that helps you. The cool thing is hopefully by the time those 3-year fixed, rates have either come back down or the clients paid down significant chunks of money on this all-in-one so that the interest impact is not that great. Okay, let me cover this. I get asked all the time, hey, so what's the minimum monthly payment on this? First of all, on an all-in-one, you don't write checks out to the bank. You have your deposits coming in, and then you have your expenses going out, and whatever's left over remains as equity or money that you can borrow out in the future. So what you do as far as the interest getting calculated, in our scenario, our client has a credit limit of $825,000. Let's assume that there are no deposits, no withdrawals for the whole month. It stays flat. They calculate interest as simple interest. So every single day they'll take the balance of $825 and they will take that times 5.8%. And then they'll total that up, add every single day together for the month. And that's how much interest is due. And it is automatically drawn out of the all-in-one loan. So you don't write a check, it's just drawn out at the end of every month, or usually it's around the 21st of the month when it happens. And you can see that in this scenario, it'd be approximately $4,042. And again, that assumes no deposits coming in to reduce balances or no other draws. And we know that in this scenario, it's not going to stay level at 825, but it helps show you how interest is calculated in there. Let me know if you have questions on this. I love the all-in-one loan. I love helping people see if it's a fit for them. In the right situations, it's very, very powerful. I really like this in an investment property situation like that fourplex, because as you can see, our current rates are better than where the traditional mortgage is. And it gives you such a powerful war chest in the future to be able to do some cool things in real estate or other investments. My name's Miles Pitcher. Here's my contact info. Please like and subscribe. Have a great week.